Okay, I think we should start. So it's 7 o'clock. Let's welcome everyone. Welcome to this webinar. My name is Dominic Chan. I will be your host tonight to talk about angel investment. So this is a webinar organized by the Business School of CUHK, Chinese University of Hong Kong. And I see today we probably have a lot of friends and alumni or current students. So welcome you all. Just before we start, so a little bit of housekeeping. So this webinar will last for about half an hour, and I do have a lot of material ready. So if you don't mind, I may even run a little bit over time, but I will guarantee the content is very good. And also, during the webinar, if you have any questions, please type in the Q&A box. So tonight, we are not going to use the chat box. We're going to use the Q&A box, and I will start looking at the questions at the end of the webinar. So write your questions in the Q&A box, but we will only answer a selective of them at the end of the webinar. Right. So again, welcome to this webinar about startup investment. And tonight, I am actually going to use my own company, which is called Dark Horse Investment. And I'm going to share my experience as an angel investor, and I will also tell you a little bit about what angel investment actually is. Now, for those who don't actually know me, let me just give you a brief introduction of myself. So I was a graduate from Cambridge. I did my undergraduate and my PhD there, and my background is actually I'm an engineer by training. So my PhD was actually in digital signal processing. This technical background actually has helped me a lot when it comes to investing in startup, because these days we are talking about mostly investing in technology startup. So with a technical background, it helped me to understand some of the technology as well as the application and the implication of what these technology can do. So also, I am currently the Associate Director of the EMBA program, and I'm an Associate Professor of Practice in Entrepreneurship with the Department of Decision Science and Managerial Economics, which is under Business School. So tonight, if anyone you are interested in joining of any of CUHK program, whether MBA and EMBA, please come talk to me or our team later on. I'm also a project director of the Center for Entrepreneurship. And you're probably aware CUHK is very keen in pushing entrepreneurship to our students. So this is one of the center that we actually help support our students as well as our academic staff to try out their ideas. And we also have what we call the PI Center, Pre-Incubation Center. Is an effort which is started by our former Vice Chancellor, Professor Joseph Song. And we're putting more and more resources there. So if any of you who are CUHK alumni or students who are thinking about starting your own company, you should definitely apply for our PI Center. Now, I mentioned I'm going to use Dark Horse as an example tonight, but I also have my own consulting firm called Decisive Consulting. Now, just to tell you a little bit more of why am I talking to you, aside from the fact that I am an angel investor, is that I have been a consultant and I sit on some of the panel for our incubator in Hong Kong. So basically, there are three government-sponsored or government-owned, but run independently incubator. So they are, of course, the Science and Technology Park, they're the Cyberport, and then also the Hong Kong Design Center. And so I have been in various capacity as a consultant to the incubators on the selection panel, as well as a corporate venture fund, which is the investment fund of Science Park. Formerly, I was a consultant with McKinsey. I also a consultant at A-Connect, and I have actually also run a number of startups before. I must say some are no longer around, but then some are still around, and that is quite normal. If you look at startup, people often talk about the failure rate. They talk about in 5 years' time, only 5% of companies startup that would be still around. So I hope that I actually have beaten the odds. So some of these companies are actually still around. So that's kind of my background. I'm an angel investor as well as a entrepreneur so I have been on both sides of the table. So I understand how each other think and try to match and make the best deal. Okay, so we only have about 30 minutes tonight. So I have a lot of slides, but let me try to cover as much as possible. So Dark Horse Investment is my company. As you see, the reason we picked this name is if you bet on horse racing, if you bet on a dark horse, it means a horse that it has a very high rate in terms of, because people think it's not going to win, or maybe people don't know that it's going to win, and therefore it has a very high return. However, it is very true that if you actually lose, you lose all the money that you bet on that horse. So I in a way, we think angel investment very much capture that kind of essence. You bet on a horse that is somewhat uncertain, but potentially with high return. But at the same time, as an angel investor, you prepare that you might lose all the capital. This is very different from you invest in the stock market, or you invest in property. Very rarely your investment will go to zero unless you leverage, unless you play with margins. So by the way, our Chinese name is called Bak Lok or Bo Le. And as for the Chinese speaking friends here, Bo Le is someone in legend has it that he is a very very interesting person who know how to tell a winning horse from the losing horse, right? He can see which is we call the 1,000 miles horse, right? 千里马. So that's dark horse. But what do? We do angel investment. Now, I don't mean that we're just raining down money as an angel and so everybody can get some money. No, but we'll talk a little bit more of what it is. Now, we need to start with this graph to explain what do we mean by angel investment. Now, if you look at this, some of you may have looked at this before. On the x-axis is a timeline, but the timeline also supposed to reflect the stages of the company. And on the y-axis, sometimes it's being mislabeled as revenue, but I think cash flow or cash reserve or cash is supposedly is a better term. So if you see the same graph which says revenue, I don't think that's the right representation. Now, if you look at the timeline, right, let's start with the very bottom left. This is where the beginning of time of a company. So a company just started. If we're talking about an entrepreneur starting a company, he has just an idea. So therefore, there is no product, there's no service, so no customer, no revenue. And while this entrepreneur is trying to or struggling to launch or develop his product, he's already burning money. Why? Because rent, he may need to hire some people, he may need to buy some hardware, equipment, or table, or a lot of things. So he's burning money, or maybe paying rent, hiring people. So therefore, the cash flow must be negative. Now, at some point, hopefully, he launched his product, customers start coming, and he start getting revenue from customer, which offset his cost, his burn rate. Now, as that progress, so you see the curve, right? Hopefully, it's not keep going down, and at some point it start turning up. And maybe, just maybe, at some point, his cash flow actually hit neutral, which is break-even point. Well, then, in a sense, it represents that this startup can now cover its own cost by the revenue that it received from customer. That is a major milestone, reaching a break-even point. But before that, right, we call this the valley of death. Now, since it's not really cash flow positive, and any startup who need to climb out from this valley of death must rely on investment capital. Now, if I ask people, hey, who's the first person or persons to invest in a startup? Well, the answer is the entrepreneurs themselves, the co-founders, right? You come up with your own money and you put in your own company. Now, that may well be true, or if the entrepreneur can actually afford the capital, but that wouldn't last very long unless the entrepreneur himself or herself is actually very rich or come from or with a rich uncle. So therefore, it's not going to last very long. And so therefore, very soon, this entrepreneur would need to think about taking outside money. Now, but who on earth at this stage would invest in these people? Now, even before the angels, there are what we call, if you look at this graph, you see the 3 Fs. It represents 3 different group of people who just might be willing to invest in the entrepreneur. Now, you probably can guess, 3 Fs. So what are the 2 Fs, right? The first 2 Fs. And you're right. The first 2 Fs are family, because your father loves you, because your cousin, like you. And so family might give you the money. And the second F is, of course, your buddy, your friends, who maybe, just trust you and, you beg them. And then they say, okay, I will invest some money. Now, the third F, if you have not heard of this before, wait for it. The third F is fools. Because who on earth at that stage of your company would invest, right? Because it's super high risk. There's no certainty of your success, and you are still losing money. Your product is not out yet, and there's no revenue, and there's so much competition usually, right? So only friends, family, and fools will invest in this stage. Now, soon after that, in fact, probably at the same stage, comes along some angels. Now, why would they invest, right? For various reasons. First of all, they are definitely looking at high return, because the risk they're taking at this stage is tremendous. Only a high return can justify that kind of risk. And sometimes they are an entrepreneur themselves, or they have been, and they become somewhat successful, and they know what you've been going through. So they come to your rescue, but bear in mind they're not fool in a sense that they will look at things that they think is viable, things that they understand, and certainly things that they think that have some chance of becoming successful. Now, this is the very beginning, right? Now, and then a little bit after that, we call the seed round, the seed capital. This is still very much at the startup stage, but a little bit after the angels and the friends and family round. Now, for completeness, I shall also explain the rest of this graph so that you put things into perspective. We just covered the very, very startup stage. As I mentioned, right, it is a major milestone if you can afford, if you can actually achieve break-even point, because a break-even point means it's a proof of concept. Your idea, your product is sustainable. If you, at the break-even point, even if you don't take investors' money, in theory, you should be able to run yourself because your revenue can cover all your costs. That's why it's called break-even. However, why not make it bigger to scale up, right? Because you have something that can break even, but can you make more of this, right? Make it a bigger company. So this is what we call the early stage, and this is where the VCs, the venture capitalists, will come in, because they are looking for high growth, high return stage. Angels, can accept a proof of concept stage, seed capital, right? So but then we are now talking about a much bigger sum because you have already proof of concept. So this is a stage where maybe instead of one shop, you should open 20, 100 or more, or even franchise. If you have initial success in number of downloads, right? We don't want just staying at tens of thousands. Can you make your downloads, your app download to millions or tens of millions, right? So the venture capitalist is looking at that kind of exponential growth, and therefore they know you need a lot more capital because expanding beyond one shop to 10 shop or even cross country, cross the border or multinational, right? So you will require a lot more capital. By the way, that kind of rapid growth cannot last forever, and therefore you enter what we call the late stage or later stage. Now, at that point, you probably are already sizable, and you're no longer looking at just organic growth. Maybe you are, but then that organic growth is going to be a lot more difficult, and you probably have a lot more competition, and you're now competing with other companies that are of similar size. Now, therefore, you will need yet more capital to bring you to the next stage. And during that time, you might even be big enough to think about acquiring smaller competitors. And certainly acquisition would require more capital. And at this late stage, this is usually where the so-called private equity will come in. So you see Series A, Series B, C, and then sometimes Series D. And that's how you distinguish these different stages, because you are at different stage of growth and different stage of thinking about acquisition. Now, maybe you are then ready to actually go for IPO, your initial public offering. So you get listed on the stock exchange. And maybe there will be even bigger investment or later merger and so on. Now, of course, not every company follow the entire path, but this is very typical, and it does separate out. When you look at investors, and they tell you that I'm an angel, I'm a VC, I'm a PE, then you know what kind of stages they're talking about. But also, if you look at the timeline, it tells you the different kind of exit expectation. We'll talk more about that. But tonight, we focus more about angel round, and I will contrast a little bit more with VC. So what is the typical size of an angel investment, right? It can be as little as 5,000 US. And you probably have heard the story about the Stanford professor who indeed invested just 5,000 US into a Stanford graduate by the name of Larry Page. And yes, that is Google. So I wish I have more students come to me, who later on becomes founders of unicorn. Then I would be gladly investing a small sum in each of these companies. Now, so angel investment typically also do not exceed $1 million. In fact, that would be rare. I think a true angel round is probably around 500K US dollar max. There is a reason for that, by the way, because for a startup at that stage, you shouldn't be needing that much capital. And number two, at that stage, your valuation is probably not very big. So if you accept too much money from angel investor, for every dollar you receive, right, you have to give the investor some shares. And when you are at the early stage and your valuation is not very high, and the investor giving you a large sum, that implies you have to give up a lot of capital. a lot of equity. You don't want to get diluted so much at this early stage. It kind of kills your incentive as an entrepreneur because you're losing control of your company. So this is the balance, right? Therefore, I would advise, being angel investor, you shouldn't be investing too much. Probably you don't have that much to invest anyway. But on the receiving end, it's not good news to give up too much equity too early. Now, also, these angel investors, typically they have no analyst support. Now, although we do see increasingly startup funds that are properly set up as a fund with associate, with analysts and so on, but by and large, there are plenty of angel investors. Maybe I shouldn't say plenty, but there are a lot of investors out there, angel investors, are individuals who have no team behind them to support them in terms of due diligence or a lot of the number crunching. Now, and also the key differences, therefore, if you talk about angel and the next round, the VC, angel investors usually is their own money. But as I said, we do see more and more angel funds, which is playing with other people's money. But VC, very rarely you see their own money. VC are mostly set up with other people's money. They are called the limited partners. And then there are the managing partner who may or may not have put in some money, but they are running the show. So that's the key differences. And I want to quickly go through this slide. I realize time passes really quickly. I do have a very important slide that I would like to show. Just quickly comparing angel and venture capitalists. Source of funds. Angel investors usually by themselves or a group of friends. And VC usually is institution money and plus some individual investors. Deal size, angel very rarely exceeding $1 million. Now, venture capital, I'm even being more conservative. These days, 5 million would be small. 40 million or more is possible. So these days, but however, one thing you need to notice, there's a gap. If angel investor would not invest more than $1 million, and if VC would not invest less than 5 million, so if your company, it's at some stage you are needing investment of like 2 or 3 million, then you are in trouble. That's what we call the funding gap, but we don't have time to go into that. Different stages, angel is earlier stage. So if they look for any exit, that would be longer. VC coming at a later stage, therefore their horizon is also shorter. The other two I won't go through. So who are dark horse then? We are the individual investors, but we group together and we invest by project. And there are other wealthy angels who are people who are make their money other ways, or they are entrepreneur turn successful entrepreneur, and they exit and they actually now have sitting on a lot of capital who want to invest back to startup. And then also some other angels, these are individuals who are very experienced, and startup would love to have them on board just to use their name on board of advisor. So these people, they invest their time instead of just money, and then they still get stock options and so on. So these are kind of different type of angels, and we do play different role and different time. Now, I really want to go through this, and I apologize, we're already at 25 minutes into the presentation. So if I quickly go through this is my last slide of tonight. I call this from pitch to hitch. Well, because when a startup pitch to the investor, do a PowerPoint presentation or then product demo, and hitch means when they get married, right? So what is really going on in investors' mind? There are 7 things. I'm going to show you some diagram. By the way, this is not an exhaustive list. This is just my experience. This is the first slide. Now, if we are in a class, I would have asked people, what do you think? In my mind, as an angel investor, when I look at a startup, the number 1 criteria is the team, the co-founders. Are they passionate? Do they look they would not stop until they become successful? Do you think they have the right mindset? They can endure hardship, and with a good combination of skills, or they can learn quickly. team, the people are definitely number one. We are, by all means, we are investing in people first. And number two, you guess it, is the idea. So yes, the people are definitely most important. The idea is also very important. It's just that if we have to force rank them, I would definitely put people first. Meaning with the best team, even if the idea is with some flaws, you think they can still execute, or they can adjust, they can pivot. But if the team is not working very well, even they have the best idea in the world, it's going to fail. So team first and then idea. Now, number three, well, I would love to look at startup, and then I need to see that they have unfair advantage. So this diagram, of course, is two players in a basketball game. And it's very clear who would you invest in, right? Unless the guy actually have some superpower. So we want to invest in startup that has unfair advantage. Remember, investor has their money, and if they don't feel right, if they don't feel this company really is going to make it or have unfair advantage, they can always walk away. They can always walk away. So you're taking big risks. If you invest in something that already looked mediocre, or you don't think they have any advantage, the likelihood is it's not going to survive the competition. Okay, number four. Now, when I do this in the class, there are many different guests, and very interesting. You mean they need to be hungry, they need to survive. Actually, for me, this is the diagram where I want to make sure money is like water I give you while you are in the valley of death. I want to make sure that you are getting enough money to actually cross the desert. Meaning, if I give you the money this round, and you will be in a position of needing more money very soon, then that is too distracting. Because if I ask you how long do you think it takes for someone to start pitching for investors to they actually see the money in the bank, right? If you say 3 months, I would say that is super fast. 6 months is not atypical. So therefore, it takes a long time, when to meet, due diligence. They are all busy. So, when and, how they meet the meeting, they look at your bank things in order and so on. I mean, 3 to 6 months is very typical. So if you needed the money yesterday, it's too late. But if you take one investor's money, and then you need to be fundraising again very shortly, that is too distracting to the founder. You should be focusing on building your idea, building the business. You shouldn't be spending all your time finding investor, or you shouldn't be in that position so desperate. So therefore, I want to see the company, in taking the money, and then can really take them to the next stage. Number 5, scalability. I think that's something that everybody would agree. It's just that you can invest in something that doesn't scale, but give you good cash flow. So tonight, I am talking about investing in scalable business. That is where your capital will grow. That is when you will need VC's money to expand. And number 6, the financial. Now, I say this, I want to see a profitable business. I want to see a healthy financial business. But often people will ask, hey, what about Uber? What about WhatsApp? What about Instagram? These companies typically you see in the news where they were acquired for huge amount of money who have never been profitable. And I say, well, okay, they are a different kind of beast, and true. But if you can build a business that takes WhatsApp, for example, when it was acquired by Facebook, it has 900 million users every day. If you can build that kind of business, then I think you're worth something strategically. Your value doesn't come from you're running a revenue minus expenses business, but your value comes from the size of your user group. So I'll give you that. I mean, so in any case, healthy financials or healthy user base acquire and good stickiness. Now, number 7, of course, is exit. For angel investors, what is an exit, right? It doesn't have to be an IPO. In every round along the way, when you have more, have VC money, another VC or private equity, often these new money, they would like to clean up the investor list, and then they would let the angel investor to make some profit, and then they would say, thank you very much, your service is no longer needed, and I will be very happy to walk away with a decent return. But whether are we happy if the company go IPO? Yes, that would be a good strategy too. Like one of my company actually gone IPO. So different stages of exit are all good. But what I mean by this is when we invest, at the time of investment, can we kind of visualize what that exit looks like? If we can't really think about, hey, is this company going to be acquired by a bigger company? Is there a VC who is going to invest in this kind of area? If you can't visualize that, then I'm a little bit stuck. So this is important to look at the exit as well. I realize that it's just past 7:32, so I should stop talking there. But I hope with this short amount of time, I have already given you a good glimpse of at least some intro of what angel investment is, hopefully. And so now I will turn into some Q&A. Let me just quickly glance through the list and then pick some good questions. Okay, so I will just pick a few. I think we already overrun, right? I'll just see the first question. What is your advice for individuals who are looking to get into the angel investment or VC investment and looking to start from small ticket sizes? This is where I started, in fact. So what I would tell you is, to start with, there's a reason why I partner with a few friends to form Dark Horse. Because from the startup perspective, you're not just one person, you're a group of people. Hopefully you want to find the right combination. And this enhances your deal size because you pool friends' money. And it also enhances your due diligence ability. And then also the startup will look at you more favorably because you have more people to help them and your deal size is bigger. So to start as an angel, I would say look for some friends that would be interested and actually form a small group. Now, where to look for deals? There are now a lot of conferences. There are a lot of incubators. So do participate and run around, and not for two reasons. One, you get to see more deals, and you probably run into other angels that could be your co-investor. So I'll leave that with the answer at that, right? The other question, as an angel investor, what factors will I consider? I think what I mentioned about these 7 is already, but let me add, in addition to these 7 things that I look at, I do believe we should only invest in something that at least you understand the basics. So if you find that if you're given something that rely on physics or biology or that's something that you don't actually understand, I tend to shy away from those because I cannot truly. Well, first of all, it's harder to add value, and also it's harder to understand the implication. So again, back to the first question, right? Why I start with a group of friends. We have a diverse background. So with more people, by the way, I have 5 other co-partners. And so therefore, we collectively, we can cover a wider range. So long as one of us or 2 of us claim that actually, yeah, I do understand that type of business. So industry-wise, I try to invest something that I understand. In that case, technology, meaning digital technology. One of my friends is very good at biotech and so on, right? So I hope that answers the question. Oh, someone asked what is unfair advantage? Well, what I mean by that is sometimes, some company, they start with a patent. They start with some very interesting research. Some company, they have already some sort of agreement in place, which is critical to the business. So patent, market share, or you are the first mover advantage, you already trademark certain things, or your team is somehow with the best knowledge and you are the best team to execute, that kind of unfair advantage. That's why while I'm describing it, you find that it's actually super hard for startup. But sometimes the fact that you are the first one but you are executing it well is a good advantage. But how quickly other people copy is a different matter. But if you have a patent on certain technology, that is certainly something hard to mimic, right? Now, okay, maybe I do see a lot of questions. Maybe I'll just randomly take 2 more, and then we probably have to wrap up, I guess. Let me just look at the question, right? Okay, do we trust our gut or the proposal? Now, you see, I probably echo this, so let me just repeat the question. An angel investor share with this friend that he trusts his feeling on someone who wants him to invest rather than the proposal. Well, in a way, that is what we are saying, the team first, right? So if I know someone, let me give you an example. One of the project we invested, we were investing in a 24-year-old. She was a graduate from Hong Kong U. She didn't write a really big proposal, but she did go through some accelerator program training. So she was very seasoned and she was very young, but I trust her in the sense that she gets her hand dirty. She do a lot of things that you would imagine, wow, this is someone who's really serious. The fact that she was really serious, she went through a lot of trouble of doing things, I find she was very trustworthy. Now, I have to say her business didn't work out in the end. And then we sold the company to, it was acquired, just kind of fire sale, but then at least it was acquired. We didn't need to liquidate. But she has always been a good entrepreneur. In that sense, yeah, trusting the person, as I mentioned, number one. Okay. Okay, maybe just, sorry, maybe just, I'm just randomly looking at the questions and one more. Okay, let's see what is an interesting one, right? Okay, maybe I'll take this one. It's a simple one as well. This is someone who asked, as an entrepreneur, how can I find angel investors? Now, I can speak of Hong Kong, my experience in Hong Kong. By the way, I've experienced in Hong Kong, Cambridge, Israel, and Silicon Valley, and Singapore, and a bit of China. Because there are now so much more noise, there are always some association for angel investors. So let me take just 1 minute to introduce. There's a Hong Kong Business Angels Network, for example, Hong Kong BAN for short, HKBAN, and it's an alliance of all the angels in Hong Kong. So there are a lot of members, serious members, individuals, as well as running angel investment as a fund. And it is co-organized by Hong Kong Science Park and Cyberport, and then some of the university. CUHK is one of the founding member. And it has 2 purposes. One is actually train and get and nurture more angel investors. But more importantly, they want to match angel investors with startup. So there are a lot of events like demo days, pitching event, investor matching event, and even like elevator pitch and angel conferences. So look for these organizations. So as I mentioned, Hong Kong BAN, for example, or participate in a lot of the event that is organized by Science Park and Cyberport. And also like co-working space like Cocoon and so on. So you will find potentially you will see some angels there. Now I realized, okay, 7:40. We actually overrun by 10 minutes. I should suggest to our team that maybe 45 minutes is a better timing. I know there's still a lot of questions. I'm sorry I couldn't cover them all, but you can maybe later on send me email or something. Now, before we go, I just want to say a few words. So if you have friends who want to read MBA or EMBA, please welcome and talk to our team. We will continue to run more of these seminars. I hope that you find these useful. Hopefully, by the way, as I mentioned, right, this is actually part of my courses for undergraduate MBA and EMBA on entrepreneurship. So, okay, thank you very much, and I hope to see you again in some other webinar. Thank you for coming.